Good morning, everyone, and welcome to this quarter's Corporate Cash Briefing webinar and our last briefing of 2017. You are listening to the largest and longest-running conversation on the issues affecting corporate cash decisions in our industry. As usual, we're going to discuss high-level macroeconomic issues, regulatory and legislative issues, and the geopolitical issues that our corporate treasury audience is thinking about and asking questions about right now. My name is Kevin Ruiz, a principal with Treasury Strategies, a division of Navantis. I'm joined today by my colleague, Managing Director Tony Carfang, as well as today's panelists, Michelle Price, the Associate Policy and Technical Director for the Association of Corporate Treasurers, Sue Hill, the SVP Senior Portfolio Manager for Federated Government Money Market Funds, and Roger Merritt, Managing Director for Fitch Ratings. Before we begin, I want to remind everyone who's registered for this session that in a day or two, you're going to receive a copy of this presentation and a link to this recording. If you have any questions, you can do so in the question box in the bottom right-hand corner of your screen. We'll handle those questions offline in the coming days. Tony, for our last webinar of 2017, I'll let you kick things off.
Well, thank you, Kevin. And we're going to first talk about the corporate cash levels. And as we can see on the slide, corporate cash levels continue to increase, and the trend line remains very, very, very strong. In the U.S., corporate cash levels actually rose by $70 billion in the past quarter. Up to $2.3 trillion. That's an increase of 3.5% in just one 3-month period. As the trend line shows, the rate of increase seems to be actually independent of changes of interest rates, levels of economic growth, or even the political landscape, and it seems to be very strong across the board. I mean, the trend lines over the last several years for not just the U.S., but the U.K. corporate cash, the Eurozone, all three of those jurisdictions have hit record highs. The Japanese corporate cash is almost at a record high, just a slight downtick last quarter. Now, if we look and actually plot the trend lines, you can see on this chart that the strength of the regression line is just incredible. The R-squared, which measures the strength of the regression, is like 0.96, 0.99, 0.96 across the board. Now, we don't have that same tight regression in Japan, and the reason for that is the Japanese corporate cash has actually been flat for a very long time, but then sort of kicked in, the growth kicked in starting in about 2009, and if we were to have measured this regression line from just 2009 going forward, we would see that Japan is not an outlier, but actually very strong relative to the trend line. The other thing to notice here, in all 4 jurisdictions, over the past year or year and a half, the levels of cash have risen above the long-term trend. So even though the economies seem to be picking up, corporate treasurers are still building their cash levels, which is an interesting phenomenon that we're going to continue to explore. Now, on the next slide, we see corporate cash relative to GDP by region. We began measuring this several years ago, and a couple of interesting things jump out here. First of all, corporate cash as a percent of GDP in the U.S. is the lowest of any of the regions that we measure, and has risen by the least amount over the last decade and a half. Nevertheless, the increase is still strong. In the United States, for example, corporate cash was 9% of GDP at the beginning of the millennium, and has now risen by a full third to 12% of what is a GDP number that has doubled over the period as well. So while it looks like it's not a huge increase, in fact, it is more than a doubling of the level of corporate cash. And of course, in the other jurisdictions, we see even higher growth there. The next chart actually shows the regressions relative to GDP, and again, we see the same solid trend lines and tightness of fit. One way to look at this, by the way, is if you look at the slope in each of the jurisdictions, that tells you basically how much corporate cash would increase for a specific increase in GDP in that jurisdiction. So, for example, in the United States, we have a very strong trend line, in fact, a 0.96 out of 1.00 degree of fit that says that corporate cash increases by $134 billion for every $1 trillion increase in GDP. That's obviously very huge. In the UK, it's 476 billion pounds per trillion. In the Eurozone, it's 414 billion euro per trillion, and in Japan, it's 442 billion yen per trillion. In the U.S., that 134 billion per trillion, well, it's an interesting statistic. It's been flat for the last couple of quarters. However, in all of the other jurisdictions, it's increasing. So we actually find corporate cash increasing more rapidly relative to GDP outside of the U.S. than inside of the U.S. Now, on the next slide, we look at the reserve balances the banks are holding with their respective central banks. And we've mentioned this before, but I want to go through this again because there's something, well, a couple of interesting things happening. First of all, although we've heard central bankers talk about tapering or ending their quantitative easing, particularly in the Eurozone, if we look at the bottom left here, bank reserves at the European Central Bank are actually skyrocketing, and this doesn't match the words coming out of the leaders of the central bank, but the statistics don't lie. So what we have are skyrocketing reserves at the European Central Bank. Reserves going up really rapidly at the Bank of England as well on the top right, and the trend line, has been a very consistent trend line in Japan. Now, when we look at the U.S., we pointed out a couple of quarters ago that the U.S. bank reserves peaked a couple of years ago and have fallen by about $600 billion or so. And it's interesting, on our last briefing, we actually showed a chart that showed dollar for dollar a decrease in bank reserves at the Fed, matching dollar for dollar the decrease in bank liabilities held by prime money market funds. So when the U.S. regulations on prime money market funds, the draconian ones that have almost killed prime funds, started causing assets to leave prime funds, prime funds were less able or had fewer assets, less cash to purchase bank liabilities, and the banks made up for that shortfall by reducing their reserves at the Fed. Now, we see a little blip here last quarter, and as we mentioned on the last cash briefing, we said we were going to go back and investigate that. And we see something very interesting here. We have a very strong hypothesis where we see last quarter about a $300 billion increase and then just a slight decrease in the most recent quarter. The U.S. Treasury actually hit the debt ceiling limit in the second quarter, at the beginning of the second quarter of this year. So you may have heard headlines that we're concerned about the debt limit ceiling being breached or approached in December. Well, that actually happened in April, and the Treasury is doing some interesting market operations impacting its balance sheet and the bank's balance sheet and the Federal Reserve balance sheet to stay under that debt ceiling limit. So there's some smoke and mirrors here. Other people would call it Mickey Mouse game playing. You can call it whatever you want, but we would suspect that next quarter we're going to see a different picture here. Now, before I turn this over to Kevin and we go into our deep dive, we just want to mention that next week the AFP conference is taking place in San Diego, and we will be at booth 401. So please stop by and visit us. And at booth 401, Treasury Strategies will be introducing a new bank relationship management tool to help companies optimize their bank relationships and manage bank service charges. And we will be offering a special offer for corporate treasurers who are interested in taking advantage of the software. If you're there, please stop by our booth. And if you're not going to be there, you can click the link, treasurystrategies.com/in-depth, and we'll send you some more information. Or in the bottom right-hand side of your screen right now, in the question box, just type in the word in-depth, and we'll be happy to follow up with you. So with that, let me turn it over to Kevin.
Thanks, Tony. Normally, during the cash briefings that we've been doing over the decade or so, we like to go into a deep dive into a topic that's of relevance to our corporate treasury audience. Today's discussion is going to be a little different. And the reason is that one of the things we've been noticing since the spring of this year is the amount of client work and client inquiries we're receiving around cybersecurity, cyber insurance, cyber fraud. It seems like that's a word that just people like to ask about. And it took us a while starting in the spring to understand that while our banking partners seem to be asking a lot about the risks that are emerging around cyber and cybersecurity, our corporate clients are actually asking not just what is it, but tactically, what does that mean for them? What does that mean for their control environment with respect to payments fraud, and are they sufficiently insured against a potential event? So we wanted to spend a few minutes here just talking about this topic before we move on to the next panel discussion. As we've seen in the recent news, and many of us have experienced firsthand, I suppose, for-profit hackers as well as nation-state participants have, I guess, been able to steal what I would call valuable information, money, and intellectual property from companies and other entities worldwide. Many of us have felt that on a personal level. If you think about just the Equifax breach that recently occurred, I myself suffered from the Office of Professional Management breach in 2014-2015. We've all been impacted, whether it's professionally or personally. And for those of us that think we haven't, we will be. What I want to do is talk about a little bit about all the ways we can be attacked, both in traditional and more exotic fashions. And if you look at some of the payment fraud events that we've seen, you can organize them around, you know, the more traditional things like altered checks, forgeries, counterfeit, lockbox scams, or anything like that. But then you start to see these more, well, some of them aren't emerging, but some of them are. Unauthorized ACHs and wires, social engineering attacks, keystroke recording and using that, password in social engineering, so on and so forth, as well as what we've always worried about with traditional uses of credit card, employee card, and P-card programs as well. So the question becomes, you know, what do you do about it? We've had so many clients come to us, and we're working with clients right now. They're asking about cyber insurance, for example, and our first question to them is, well, how do they even know what's at risk? Are they talking about revenue? Are they talking about safety? Are they talking about their reputation? You can't necessarily insure against that. Maybe it's all of the above. So how do you assess the value of what's at risk? How do you implement the appropriate controls from a technology as well as a process point of view? And then how do you build your own confidence that your organization has the right policies in place at the right level to ensure against the residual risk that's left over after you've done everything else you can to prevent an event? So I want to say that essentially the point is that it's more than just a few questions. So my colleague Jeff DiOrio and I are going to implement a series of webinars starting next month. And we're going to be talking about payment fraud, cybersecurity, and risk management with a focus on the technical system controls, the process controls, and then what to do about managing the residual risk, whether it's an insurance product or something else. We're going to discuss how to identify and understand what's at risk, how to address and manage it, how to monitor it, and then what else you can do within your own organization to help defend yourself and those around you. So now with that sunshiny note, let's go on and move forward and talk with our panel here. And again, our panel participants, Michelle Price, the Associate Policy and Technical Director for the Association of Corporate Treasurers, Sue Hill, SVP, Senior Portfolio Manager for Federated Government Money Market Funds, and Roger Merritt, Managing Director for Fitch Ratings. So what I want to start off by talking about is, as we go into the rest of 2017 and we start looking into 2018, we're seeing a conflict, I would say, as far as the central banks, and are they moving together? Are there different trajectories? What's happening and why? Tony alluded to what's going on with the ECB versus the U.S. Fed. And Roger Merritt, I'm going to start with you. What are your thoughts as far as divergence or convergence as far as central bank, I'd call it harmony, would go?
Yeah, thanks, Kevin. You know, I think certainly in the U.S. there's a lot of focus on Fed policy, and both from the perspective of rate increases, you know, as well as the process of beginning to unwind quantitative easing. I mean, Fitch's own view in our most recent global economic outlook is that the Fed will do another quarter-point hike in December, and then we're predicting another 4 hikes, 100 basis points in 2018. But if you sort of step away from the U.S. and look around the world, the reality is that rates are very low and on a flat trajectory virtually everywhere else in the world. In the Eurozone, they're negative. They're in Japan. The short-term policy rates are essentially zero. And really everywhere else in the world that you look, even in Asia, you know, there's really no sign of upward rate movement in terms of changes in policy rates. And you know, the same I think is true when you look at long-term rates. You know, pretty much range bound around the world, and certainly in places like Japan, you know, you have 10-year Treasury rates hovering around zero. So what does that tell you about inflationary expectations and growth and ultimately interest rates over the sort of the medium to long term?
Thanks, Roger. Any predictions on the next U.S. Fed chair?
It won't be me.
Right. Correct. You know, my personal opinion, I think I've expressed this to the panelists, is barring someone someone like me that would have no business in that role, I don't see there being a big disruption in the Fed's trajectory, the U.S. Fed's trajectory going forward. Sue Hill, what your thoughts on Roger's points there?
Sure. I mean, I would vote for Roger for sure. The grand scheme of things. And actually, I would also echo your comments, Kevin, that as you look through the options that are available for Fed chair, it changes on a daily basis. There's certainly active betting out there in terms of who wins the nomination, which we would expect to come in the next couple of weeks. Quick development yesterday, I guess, was Treasury Secretary Mnuchin. It came out at least in informal support of Jerome Powell, who's the current Fed governor, and I think that would again be relatively friendly for the markets. He is dovish on both the regulatory and rate side of things. So more to come, but I do think it's hopefully not a huge market event. From the perspective of central banks, as you look across the world, at least from my seat, there are some similarities I see across the board. It does seem a little bit like a synchronized recovery when you look at various countries and regions. Obviously the United States has embarked upon the reduction or the beginning of the tapering of their balance sheet, and we could expect that to take place across the world, across various regions as we move forward into 2018. Growth seems to be okay at this particular point. So that's one similarity across the lines. The second is actually with respect to inflation, and what seems to be a similar theme Chair Yellen in the United States gave a speech, kind of a noteworthy speech at the end of September, where I think the title was along the lines of, inflation uncertainty, inflation, uncertainty, and monetary policy, and where she actually discussed the low inflation environment that we're in and sort of the perplexing nature of it with respect to the Fed and calling into questions the models that the Fed has been using. You can hear that same story repeated, across Europe, across, various central banks, a little confusion as to why so long into or so long after the financial crisis, inflation remains quite low in spite of signs of reasonable growth. So those are the similarities, the differences that will affect policy and cause the, instead of everybody moving in sync, but, moving at different paces, I think are obviously political and some very noteworthy political challenges across regions and countries,
sure.
Including our own.
Sure. Thank you, Sue. Michelle Price, I'm going to give you a similar question, which is, it's a two-part question. One is, what is your view on the convergence or potentially divergence of central banks, following on what Roger and Sue said? But also, I want to ask you, from your point of view, the drivers to that, because as Sue mentioned, there's inflation drivers, there's other drivers that I'm wondering what your point of view is on.
Sure. Let me just mention, first of all, just from the UK interest rate perspective, the Bank of England's Monetary Policy Committee actually meets 3 weeks today, and they could potentially put UK interest rates up, which, if they do, would be the first time in 10 years. And in fact, the bank's governor, Mark Carney, he's gone out of his way to signal that a rate rise is on the cards. The general financial markets and economists are betting on a 25 basis point hike, and that would take UK rates up to about 0.5%. Now, to answer your question, I think the motives for raising rates in the UK are similar to those in the US. We've got asset prices and borrowings looking a bit frothy. The global financial crisis, as was mentioned, was 8 years ago, or over 8 years ago now. So we're well into recovery, and therefore I think a rate rise doesn't seem premature. And also there is a need to raise rates because that will give the central bank some headroom for future rate cuts. And, these future rate cuts will be inevitable when the next recession strikes again, which, sorry to put some doom and gloom on this. Wage growth here in the UK is subdued. I think that adds something into the picture. And also, I think in the UK and also in some of the markets we've been talking about, the US, unemployment is actually at historically low rates. And I think that is a key factor as well.
Great, Michelle. Michelle, one more thing before we move on. Do you have any thoughts on the current activity as far as Brexit negotiations go?
Interesting question. In the UK, the governor, again, of the Bank of England, Mr. Carney, he argues that Brexit is likely to slow UK productivity, weaken sterling, and raise inflation pressures. And for those who are outside the UK and haven't really followed what's going on, last month, our Prime Minister May, she gave a Brexit speech in Florence, and the main objective of that speech was to try and move negotiations with the EU forward. I listened to that speech, and my main takeaway was that the government is committing to a status quo transition period, and I'm taking that as business as usual during the transition. There is still a need to resolve the divorce agreement. A figure of $20 billion is being reported in the press, but real trade deal discussions won't start until next year. So if I was to summarize, there isn't any real decisions that have been made yet, and uncertainty remains.
Great. Thanks so much. So I want to switch topics a little bit. This goes back to our individual conversations that we have before this this panel discussion. Roger Merritt, I'm going to start with you because this is something that you brought up that caught my attention, that we're still thinking about, to a great extent, money market reform, not just in the United States, but globally. So maybe you could kick us off, Roger, and give us some of your thoughts on what's happening with the U.S., where we stand, and then what's going on in Europe, and we can start a little conversation around that.
Sure, Kevin, be happy to. Well, I think everyone knows that we're fundamentally a year past reform in the U.S., and I think credit to the industry that they managed through it quite well. But the reality is we saw well over $1 trillion flow out of prime money market funds, as Tony alluded to, and into government money funds with all kinds of sort of secondary dislocations in terms of the spreads for prime assets, the ability for companies to fund themselves through the short-term credit markets and tap what was traditionally a very important source of funding, i.e. prime money market funds. So they really are, today, prime money funds are a shadow of their former self. We've seen some modest year-to-date inflows back into prime funds, but by and large, we're still looking at over $1 trillion that left, the real economy and moved into funding government paper. So a year on, the picture is still one of change and uncertainty, and now we're focused on the European Union. So the EU has passed, finally, after many years of debate, has passed a new set of money fund reform regulations that go into effect and fully into effect in January 2009. And there's a lot of detail, obviously, but I think the key takeaways are that as it was the case in the U.S., a traditional CNAV, constant NAV prime money fund in Europe will no longer exist. So there'll be instead four options available: 2 VNAV options, a CNAV government-only option, and then what is being termed the low volatility NAV money market fund. And there's, without going into too much detail, I think that the key issue there and the key takeaway for corporate treasurers is that this is a market with, again, close to $1.5 trillion of assets under management, and there are fundamental changes that they're going to need to understand and consider in terms of their investment policy statements, making sure that their board and their senior management understands what the changes are and what it means ultimately for their cash management decisions and how they fund themselves. I think the good news is that it's our view that the dislocations that we saw in the U.S. In terms of asset flows out of prime funds we don't anticipate the same level of flows in the European Union, primarily because the regulators put forth the low volatility NAV option, and it seems to be attracting the most interest from investors, and I think offers a credible, viable alternative to prime CNAV money market funds. So I think on sort of ending on a positive note, I think the dislocations are going to be much more modest in the EU, but nonetheless, people need to understand what they mean and plan accordingly.
Great. Thank you so much. Before I move on to Sue and then Michelle, let me ask you something, Roger. We talked a little bit offline about money market reform rules, emerging rules in China, and I don't know if there's much to say about that yet, but I guess my question is, and this is an open, more of a rhetorical question than anything else, we were saying, well, the chances are that they're going to adhere to worldwide standards. But the question becomes is whose standards and over what time frame? And I don't know if you want to say anything about that or you're like, hey, I'm not saying anything, let's move on this.
No, I mean, we've commented quite a bit on China in our public research. It is interesting that it's now the second largest single money fund domicile in the world behind the U.S. In the aggregate, still smaller than Europe, but it stands at roughly 650 billion U.S. AUM. So it's become quite important to the Chinese economy, and it's really, I think, front and center on the Chinese financial regulators' radar screen to make sure that it doesn't create, financial instability and systemic risk. So in that regard, most recently they have proposed new regulations that go into effect by spring of next year that try to bring Chinese money funds more in line with the way they're regulated in the U.S. and in Europe in terms of weighted average life, weighted average maturity, and imposing some mandatory liquidity, minimum liquidity requirements. I would say, though, so there is some convergence, but I think the reality is that Chinese money funds on the whole are still have a ways to go before that we would view them as being on par with the U.S. and Europe. So I think it's a work in progress.
Sue Hill, any thoughts on ongoing money market reform, U.S., European, anywhere in the world that Roger covered already?
Sure. I'll touch real quickly on a couple of things. First, I think if we're all being honest, we all have a pretty good hangover from the concept of U.S. money fund reform in the discussions of reform. So I'll keep sort of comments there brief. Obviously, from the industry perspective, we've made it through. The market has adjusted. The front end of the markets, of the U.S. money markets, functions well today. We are starting to see a flow back or modest growth back into prime products in the institutional world, so including those fluctuating NAV products. But the growth will be slow, but we do expect it to continue. It's a compelling yield and total return story that we're telling, and we'll continue to do that going forward. So that's U.S. money fund reform. From a European standpoint, we are monitoring that closely. Obviously, we have a number of portfolios that are affected by the changes that will go into place. It's a little bit of a different story from our standpoint or our chair relative to the U.S. changes. U.S. changes were obviously of enormous proportions and of material influence on the nature of the product. We're viewing the changes to take place in Europe as being not quite that draconian or not quite that extreme, and manageable from the perspective of continuing to offer a product at the end that has many of the characteristics that it had going into reform. So we're viewing the changes there as being something that it will not suck the life out of us as U.S. money fund reform has. In terms of China, I'll confess up front, I didn't know a lot about the Chinese money market industry, but we do get a lot of questions about, hey, what do you think of them today versus where they were before? And I think the more recent changes that were announced from the Chinese regulators, so the China Securities Regulatory Commission, which are in phases of implementation, with a grace period, so at some point will be in place next year, touch on things that are important. So to reduce systemic risk, to reduce liquidity risks that are caused mainly by over-concentration of shareholders in portfolios, and to limit credit risk, as well. So controls that have not been in place before that can only be viewed as positive, as a money fund manager, positive for the industry in general. But I think there's a way to go before it reaches the safety of some of the other money fund, markets out there.
Thank you so much, Sue. Michelle, any thoughts on what Roger and Sue spoke on when it comes to money market reform?
Yeah, I mean, the only thing I would add from what Roger said is that the EU reforms take effect from 21st of January 2019. I agree entirely with what Roger was saying on that most corporates will probably move to the low volatility net asset value funds, and that's exactly what I'm hearing from UK fund managers and treasurers. I can't speak across Europe, but I know from what I'm hearing in the UK market. I'm not aware of any corporates that have migrated their CNAV funds yet into a LVNAV fund, but I'm expecting, and again this is from conversation, for this to happen towards the latter end of next year. And this will be ahead of the December financial year ends and the calendar year ends where, it's always difficult to manage cash and there's often liquidity challenges. I think the one additional issue corporates need to be thinking about in addition to policy changes and educating their senior management and boards, and this has come up in conversation with fund managers, is the need to iron out any accounting treatment issues. And this can arise, if you're moving to a VNAV or LVNAV fund, whether it will be treated as cash or as an investment. And our advice that we're giving to our members is to get sign-off from their auditors sooner rather than later.
Great. Thanks so much, Michelle. I want to pivot to one more topic, and Michelle, I'm going to start with you, and then I'm going to switch to Roger and finish with Sue. And I want to talk about LIBOR. Michelle, you and I spoke about this the other day, about its potential demise and replacement. Maybe you can kind of set the stage for us for a few-minute discussion around that topic.
Well, it's an interesting one. I actually had a meeting with the new president of the LIBOR benchmark administrator yesterday, and he was telling me that actually ICE Benchmark Administration, or IBA, intend to publish LIBOR post-2021, and that's sort of different to what we're reading about in the financial press. SONIA has been developed as the preferred alternative risk-free rate, but there are a number of issues, if corporates adopt or have to adopt that to replace LIBOR. As it currently stands, SONIA is an overnight rate. It doesn't have, the 1 month, 3 month, 6 month tenors that LIBOR has. And speaking to corporate treasurers, so they say, well, it needs to have tenors, and it would need to be a forward-looking rate, i.e., you know what your 6-month rate is today, not looking retrospectively. There are issues, there's some global issues here because, US dollar LIBOR, if that did cease to exist, which is contrary to what I was told yesterday, but if it did cease to exist and it was replaced by something else, well, that might happen at a different time to, say, SONIA replacing LIBOR here in the UK. So you've got cross-currency interest rate swap issues there, some basis risks arising. So, I think to sum it up, there's a lot of issues here, and if these alternative benchmarks are really going to work, then some of these things need to be resolved first.
Yeah, absolutely. You and I were talking and thinking out loud about what that means for corporate treasurers when they're looking at their contracts that are written in language that says, this is all dependent on LIBOR. If LIBOR goes away, what's the source of truth there? Is there language in the contract that says, if this, then this? And additionally, what happens if it doesn't fully go away, or there's some sort of gray area where the contractual language doesn't cover that? Then what the heck do you do?
Yeah.
Yeah, go ahead.
The interesting thing is, if post-2021 LIBOR is still there, which is, the message I was told yesterday, well, that is, that in some ways complicates things a little bit, in that some contracts, that still reference LIBOR, you'll still have to use LIBOR because it still exists. And there's talk in the market of this move towards, here in the UK, SONIA. Are there going to be new contracts that reference SONIA? So, it is a complicated issue.
Yeah, absolutely. Roger Merritt, any thoughts on this discussion around LIBOR and the impact of corporate treasurers?
Well, I think Michelle raises a lot of good points. It's not it's not something that I'm an expert on, but I think I think she's right. I think let's all of us have been accustomed to using LIBOR for most of our professional lives, and I won't tell you how long that's been for me. But it's an index that there's rich data, as Michelle said. There's a yield curve that you can look to, and I think there's a lot of historical analysis you can do to sort of establish a relationship of LIBOR to other rates in the marketplace, and ultimately determine what's the appropriate spread over LIBOR for whatever financial contracts you're engaging in. So, whatever comes in lieu of LIBOR, if in the event that LIBOR goes fully away, I think the challenge is sort of something that has something that people can analyze and get comfortable with, and ultimately base financial decisions on. In the same way that they've become, they've been used to doing with LIBOR.
Yeah, absolutely. Sue Hill, before we call it close for the day, any thoughts on LIBOR in this discussion?
Sure. It's an enormous challenge, I think, for the market over the next several years, for many of the reasons that we've already outlined. So I won't necessarily repeat those. I do think that there is. I'm happy to hear actually that the prospect of LIBOR continuing on even after 2021 is something that's being discussed. I think the practical reality is that will have to happen. There's really not a whole lot of a time to develop an alternative index, develop a functioning market and liquidity market in order to to pull off what needs to be pulled off. So it will get there, but I think it will require a little bit more time.
Yeah, I appreciate it. It's funny because I've had 2 magazines interview me in the last 3 weeks around this topic, and what Michelle just said this morning surprised me. I don't think any of us knew what we were, we didn't know that yesterday. So it's an interesting curveball, I suppose. So thank you so much for everyone who participated in today's panel. Michelle Price, the Associate Policy and Technical Director with the Association of Corporate Treasurers. Sue Hill, SVP Senior Portfolio Manager with Federated Government Money Market Funds. And Roger Merritt, Managing Director with Fitch Ratings. As always, a link and a copy of today's materials will be shared with all the registrants in a few days. And if you have any questions or comments, please feel free to contact me or any of our panelists at the respective emails. Again, please be on the lookout for our upcoming webinar series on payments controls and payments fraud, cybersecurity, and managing risk. We look forward to joining you in that discussion, and we look forward to seeing you at San Diego next week. We'll be at booth 401, and we are looking forward to showing everybody our new in-depth bank relationship optimization tool. It is very exciting. We have a lot of people that are using it. We get a lot of great questions, and we're looking forward to continuing the discussion in San Diego. On behalf of Tony Carfang and our panelists, thank you all so much for listening in today. We'll see you at the next cash briefing webinar in January. And in the meantime, go Cubs. Thanks a lot. Have a great day.